Traditional investing wisdom often overlooks critical nuances that can significantly impact retirement portfolios, especially during market downturns. Understanding these overlooked factors may help you to make more informed decisions about protecting your retirement assets in ways that conventional soundbite advice rarely addresses. Hey everybody, I'm John Llodra. I'm a founding partner here at New Harbor Financial Group. Thanks for joining me today. If you're approaching retirement or already in retirement, you've probably heard a lot of conventional investing wisdom over your years that gets repeated over and over again. Advice that frankly starts to sound more like a slogan or mantra than textured, personalized advice that you can confidently apply to your situation. Well, today we're going to challenge some of those conventional wisdom and look at 4 retirement truths that might not be quite as black and white as Wall Street wants you to believe. I'm a financial advisor with almost 25 years managing client portfolios through multiple market cycles. I've witnessed firsthand how traditional investing wisdom often fails, catching people off guard and really maybe even deluding them into certain beliefs that can derail their success, especially during their critical retirement transition phase. My academic background with an operations research and engineering degree from Cornell has instilled in me a drive for evidence and a healthy skepticism when it comes to some of the strongest held preachings of the financial industry. Today, we're going to dig deep into 4 common investing tenets of the financial industry that have become really so dogmatic that they are recited really robotically anytime markets do the unexpected. While there is some compelling kernels of truth in each of these in a long-term context, they completely gloss over many nuances that are especially important to understand for those near or in retirement. So, and especially those that don't get a do-over. You've worked hard, made sacrifice, you've got a stable financial picture, and the last thing you want to do is put things completely on the faith in the back of what I call investing slogans or themes that, again, totally miss the context. So the first one, this idea of investing based upon your risk tolerance. Now, for most financial firms, the very first thing they'll have you do if you sit down to become a client with them, have you fill out a questionnaire of sorts. And frankly, the questionnaires always look the same. They have some boilerplate information like your name and your age and where you live and all that kind of stuff. And then it gets into questions about your timeline. When do you need funds? On what timeline? And then there's a broad catch-all, and there's oftentimes different ways it's asked, but it's basically a question that says, what is your risk tolerance? Are you conservative? Are you risk averse? Or are you aggressive and risk assuming, or somewhere in between? The question is innocuous enough, and many people answer it in the way they know how. And I'm going to be the first to say that most people really fail to understand the question because it's not a question that we think is even properly asked, because this whole idea of risk is very misunderstood. And when you factor in the psychology of people, and every client of ours and every investor out there is a person with human tendencies and human biases. And when you factor in that, the whole idea of a risk tolerance is oftentimes completely misunderstood. Oftentimes we have folks that categorize themselves as very aggressive and risk assuming, yet they may be the first ones to freak out, so to speak, when the markets hit a skid and their accounts are showing some volatility. And this is not a criticism. It's just a reality that we're all human, and sometimes we fail to understand our own attitudes and realities when it comes to risk. But back to the whole question of what is a risk tolerance. All these questionnaires are indicative that underlying most firms' investment gospel, if you will, is a belief in what we call modern portfolio theory, or the efficient markets theory. I did a whole video on this that draws from sage wisdom and quotes from the people of the likes of Warren Buffett, that basically this is a very tidy academic theory that oftentimes utterly breaks down in practice. So the fact that this whole idea of a risk tolerance-based investing strategy is based upon an academic theory that breaks down in reality is in and of itself a problem. So this is a kind of a wonky chart or slide that really gets to the heart of this idea of the efficient market thesis. And there's this theorem called the capital asset pricing model and the efficient frontier. I'm not going to get too deep in this, other than that this academic theory, again, which is great in a textbook but breaks down in reality, is basically has this concept that if you take more risk, you're going to get higher return, like as if it's a God-given right that if you take more risk, you're going to get more return. And that there's this mix of stocks and bonds typically that is optimal for some given level of risk and return. And the problem is many people misunderstand what this idea of risk is. In this model, what really is meant by risk is the volatility, the daily or the periodic variation of the returns or prices of a given asset. So stocks are are volatile. Prices move up and down, and the degree of volatility in kind of a meandering way is what is treated as risk in this model. When in reality, we think of things differently. Risk is not temporary volatility, this toing and froing of a price of an asset. Risk in our minds, and really should be in the minds of most investors, is the idea of a permanent loss of capital, any decision that reduces the probability of achieving your goals. Sometimes, like at the very bottom of the great financial crisis, markets were very, very volatile on a day-to-day basis. The swings were quite dramatic. Yet, valuations of stocks and other investments were very, very good, compelling values. So the risk of loss on a long-term sense was actually quite low, even though the volatility was dramatic. This is a grave misunderstanding, not only by people answering these questionnaires, but by our industry. And let's look at a practical application of this, because one of the innovations, if you will, of our industry is these set it and forget it portfolios that you can just pick one that in the word of the portfolio says whether it's aggressive or conservative. And I've just picked out a couple of examples here. This is a couple of allocation strategies offered by iShares. One is what is called a conservative allocation, where it has 30% in stocks and 70% in bonds. And then another one where it's called an aggressive allocation, 80% in stocks, 20% in bonds. And what I've done is I've plotted this as a drawdown from its peak, each of these from their peak, going back to January 2022. Now, most folks will recall that the year 2022 was quite a challenging year in the stock market, but also in the bond market. So what you see here is you had, both for the aggressive and conservative, a dramatic drawdown. In fact, the conservative allocation saw almost a 20% drawdown on the year in 2022. And even still, this many years later, the conservative strategy hasn't regained its peak there in January of 2022. Even the aggressive strategy has subsequently rebounded several times this prior high and has gone to new highs. So it's utterly against the wisdom of this academic theory that this conservative portfolio has actually been more risky in a sense than the more aggressive one. That's just a real pointed example in a practical sense how these academic theories that underlie much of what financial firms dispel as great advice actually can be very misleading and downright damaging to your situation, especially if you're in your retirement period. Okay, the next one is, we hear it all the time, and there's countless talking pieces that young financial advisors are armed with their firms as a tool in their toolkit to essentially never get clients to sell or to always be invested. The traditional wisdom of Wall Street is you always have to be invested. And anytime you're not invested, you're destined to miss out on the best days in the market. And it doesn't take too many best days to miss to dramatically change your investment returns. And this is a slide that I put in a video that I did several months ago. And you can see the period I looked at, and it's still very relevant and timely. The period I looked at was from January 1950 to November 2023. And what I did is I looked at a fully invested scenario. This is for the S&P 500. So if I look at a fully invested period, you can see the cumulative return over that period was almost 27,000%. That sounds awesome, and it is. The go-to sales tool for Wall Street is say, well, geez, if you missed only the 10 best days in that period, your return would have gotten cut more than in half. You would have only had about not even 12,000% return. Still a great return, but geez, not even half the cumulative return that you would have had if you just simply stayed invested. Now, of course, what they don't tell you is if you missed just the 10 worst days, you did even better. You would have had a 77,000% return. And guess what? If you missed both the 10 best and the 10 worst days, you would have had a 34,000% return, better than just setting it and forgetting. And it gets even more interesting if you widen that out to say missing the 20 best and 20 worst days. You get even better. You get to almost 39,000% versus buy and hold of not even 27,000. And a missing 10 best and worst of 34,000. So why is this the case? What I've done is I've plotted the instances of these best and worst days in the market. And what you see is there are clusterings, both up and down days at very distinct point in time. And it's not by accident that a lot of these happen in major disruptive phases of financial crises. So for example, look at this in the great financial crisis. We had a massive number of huge up days and huge down days, the best of both the good and the bad. And the reality is you would have been better off missing all of those and still been better off. We just came off a very turbulent April where the stock market dropped intra-month over 20%, one of the steepest, quickest sell-offs within a month in history. And yet by the end of the month, we regained, it bounced back with some very single-day strong up days to essentially break close to even. It was down, I think, for the month about 1% for the S&P 500. Now, Wall Street will use that and say, gee, see, you don't need to be out of the market. As long as you hold tight, you're going to be okay. I have a different take on that. You basically went nowhere, but the amount of stress and anxiety that clients and people were feeling was real. People weren't sleeping at night, even for our clients who we had very conservatively postured, and that event wasn't cracked up to be in the day-to-day. But the point being is that you don't need to fear missing out the best days, especially during your retirement. So let's move on to the next one. There is one very famed investor said, diversification is really the only free lunch available on Wall Street. The reality is diversification can be a free lunch, but the problem is what traditional Wall Street and financial industry thinks of diversification. And this gets back to the risk tolerance questionnaire and the resulting pie chart of mostly stocks and bonds that come out of that, is that stocks and bonds oftentimes are uncorrelated assets where diversifying between those, you typically in those situations where when stocks are going down, bonds go up and vice versa. That's what we call an uncorrelated asset. When one asset moves down, the other moves up. And in many periods of history, that non-correlation holds true for things like stocks and bonds. But there are other periods where it holds tightly true. So this was a chart that was taken from a study that State Street Global Advisors did. The title of that paper was The Global Trend of Positive Stock Bond Correlation. So what you see here, and this goes back to, I think, 2001, and it shows the correlation of stocks and bonds both on a 1-year rolling basis and a 3-year rolling basis. So you got the S&P 500 as the stocks, and then the Bloomberg Aggregate Bond Index as the bond representative. And anytime you see this, so the black line is the 1-year correlation, the blue line is the 3-year correlation. And anytime you see that correlation below zero, it means they're negatively correlated, meaning that they tend to move in opposite directions. And for the better part of the first 20 years or so of this century, stocks and bonds were predominantly negatively correlated. One picked up the slack when the other was failing. But ever since about 2020 or so, that correlation has been decidedly positive. And going back even prior to this, in the 70s and into the 80s when inflation was running hot, basically there's oftentimes a correlation between when inflation is more sticky and hot, that stocks and bonds don't provide the traditional correlation effect and diversifying effect that they promise. And that's where we think we are in this phase of the cycle. That's why both stocks and bonds, for example, lost miserably in 2022. And if you look at longer run studies, there are times where you have to look elsewhere to get the diversification. This is a study that Bank of America did and said, well, what if we, instead of using the classic 60-40 stock bond mix, instead of using treasury bonds as a diversifier, what if we look at commodities? And this is an interesting study. They went back over this time period and going back to the 40s, up through 2024. And it showed that using commodities as a diversifying asset instead of treasuries, actually over this long period of time, actually did a better job in terms of total return. Now, this isn't meant to be investment advice, and this is a very long track record, but the point being made here is that sometimes you have to look beyond traditional assets of stocks and bonds to get the true diversification that can help investors mitigate volatility and decrease overall risk. The 1970s were a perfect case. That was a decade essentially where the stock and bond markets both lost money on an inflation-adjusted basis, and investors needed to be in things like commodities, gold, to get any kind of diversified positive returns from a buy and hold standpoint during that period. We think the years and decades ahead probably are going to look more like the 1970s than, for example, the 1990s. So really important understanding. So what are other ways you can get diversification? Well, even just using hedged equity strategies. So instead of being passively invested in the stock market, have a hedging strategy that can tactically put hedges on and off when risks get extreme. Using trend following tools. We employ a very technically based system that uses things like relative strength and trend following. So these are some systematic tools that can be used to help decorrelate your portfolio from an otherwise passive set it and forget it strategy. So the final truth or slogan on Wall Street when it comes to investing is this, and we hear it all the time, and it's got some truth if you look at long long enough terms, but it's time in the market always beats timing in the market. Anyone that looks at a chart going back to say 1900 through the present day can say, well, geez, look at the stock market's essentially gone nowhere but up. When you zoom out that far, you miss the context of some very, very significant bear markets that were absolutely devastating. This is a chart they put that goes back to 1900 right through present day. This was dated September 26th of 2024. And they showed that a 60-40 traditional stock bond portfolio, when adjusted for inflation, went through some very long periods of either barely any advance or even negative traction. So for example, in the 20 years from the late 1800s through the prior to the roaring 20s, there was a 19-year period where this portfolio lost 1.8% after inflation. And then, of course, you had the Great Depression and the damage after that. There was a 13-year period where a 60-40 portfolio barely squeaked positive on an inflation-adjusted basis. Another period, 7 years, 9 years. Here you have the tech bubble, 10 years after the 2000 tech bubble peak, and there was a negative 1.6% after inflation return for this tried and true, so to speak, 60-40 mix. And the one thing that I want to highlight here is this subtitle. Most of these periods started with high valuations on stocks and or bonds. So valuations do matter. They matter a ton, especially when you're looking at horizons of, say, 10 years. They mean nothing or very little in the very short term because they're very poor timing indicators. So a bubble stock market can become even a greater bubble, but it's over these longer periods that really are the ones that matter for most retirement investors where this can play out. So this is a little example I put together that shows really what the consequence of poor timing or unlucky timing when one retires. And, as much as Wall Street wants you to think that it's a random event when we get these big sell-offs, categorically, the big sell-offs, the ones that have those decades to nowhere, like we just saw in that prior chart, almost without fail start when valuations are extremely high. And here we are in 2025, and we're barely off the all-time highs, and valuations are, on some metrics, have only been as high as this in 1929, right before the Great Depression, and 2000 at the peak of the tech bubble. But what I've shown here is a very simple simulation, if you will, of a 25-year retirement period with a hypothetical starting nest egg of $1 million. And then I've modeled a scenario where this investor needs to pay themselves an income to support their retirement living of 5% of their savings per year. So 50,000 on 5% on $1 million is 50,000, and then give themselves a raise for inflation at 2.5% a year. So 50,000 after inflation in year 2 becomes 51,000, so on and so forth. And I've got two scenarios: one where there's a large loss in the early years, and one where there's a large loss in the later years. What we have here is a situation where I looked at the actual returns of the 1973 to 1997 period. 73-74 was characterized by a nasty double-year bear market, the losses in the early years. And you can see the average return was still a respectable 10.1% over this time frame, this 25-year period. But because these large losses were incurred early on, ultimately this person ended up running out of money in this simple analysis. Basically ran out of money, can't fund these withdrawals. Now, if you take the same sequence of returns and just reverse it, so you can see instead of negative 17.4 and negative 29.7 being the first 1 and 2 years, in reverse order, they're now the last 2 years, and so on and so forth. So instead of the last year being 31%, the first year, same average returns as you can see here, but the sequences change. And you can see the vastly different outcome. So not only does the portfolio value keep growing, but you can see the cost of the bad timing. Wall Street will like you to believe that the probability of these big losses in the early years are somewhat of a random event that you can't guess, so you might as well stay fully invested. Well, history bears differently. These things happen when valuations are high, not with perfect precision, but never have we seen major durable bear markets that took years to recover without starting high valuations. And that's where we are right now. I can't emphasize enough this need to kind of dig into some of these slogans to really test them as relates to, do they really apply to you and what's at stake? Risk tolerance. It's a complex and dynamic phenomenon. Markets really don't care about how you answered a static questionnaire based upon some academic theory. They care about where are values and what are the risks of have prices become too extreme and too exuberant, which time and time again we see happens. Not often, but when they do, the consequences can be tragic for many people, especially those in retirement. The missing the best days narrative, it really only tells half the story because it completely ignores that mitigating downside by missing the worst days can be much more important than upside capture, especially during your retirement. Diversification, it can fail precisely when you need it most. And there are a long stretch of history where true diversification requires more than just a pie chart of stocks and bonds. Can't tell you how many folks we come across that have worked with other advisors and they just get a fairly generic stock and bond portfolio, no allocations to commodities, or if they do, very token that don't have much value. We've been long proponents of things like precious metals and real assets that have actually done very well of late, and we think will be very important diversifiers going forward. And then the final one, time in the market, starting valuations and sequence of returns are hugely important. So the investing world is full of oversimplified advice that gets repeated so often that it's taken as gospel. But as retirement investors, we need to look deeper and understand the nuances and limitation of these conventional wisdoms. That's what we do or try to do for our clients and really bring it back to them and their situation. There's simply too much at stake to invest based upon a slogan or a mantra. Take the time, understand how these things work, and reach out to someone that can help you if you're not inclined to do this yourself. If you found this helpful, please hit the like button and subscribe to this channel. We put out weekly content. Typically, we try to educate and help our clients and viewers learn something from these videos. We're always receptive to comments and suggestions for future videos. Let us know other truths that you don't feel in your gut quite speak to you. We'll address those in future videos. I want to thank you for watching. Until next time, I'm going to wish you a great day. Thank you so much.